The Nasdaq finally had a bad day. It's the worst day since December, from what I can gather. And let's see why. What happened? So, as the title says, disappointing Netflix and Tesla earnings. Although earnings were pretty much as expected, the guidance is what's bad, or other stuff like the decline in operating margin for Tesla. Everyone is just overpaying for Tesla, thinking they are a tech company. No, they are just a car company, and car companies have very low margins, very low. And in order for Tesla to compete, to have to boost sales, they have to cut prices, and that's what they've done in the last 12 months or so. And guess what? They will need to do more price cuts because everyone and their grandma is making electric cars right now that are competing with Tesla. So of course Tesla has to cut prices, and that means lower margins overall. Yeah, that's why the investors got scared with Tesla, and for good reason. For good reason. Tesla is a car company, and yeah. But as for the earnings, what I can gather, they came in better than expected. But it's probably the guidance for the next earnings call. They might miss if they start lowering prices. And lower prices, it's overall good for people that do not have, I don't know, high levels of debt. In my opinion, it's good for everyone, but that's only my opinion. Netflix also, they tumbled because they reported a bit less revenue, but it was just like 1% less than expected, 1.2%. That's not that bad, honestly. However, both Tesla and Netflix are highly overvalued, right? Like Netflix, what was their PE? It's like 46. The historical market average is 15. So you're paying 3 times the PE right now. So Netflix, to become like fair valued, it has to drop like it has to drop to a PE of 15. Or if you really want to be a bit more astute, look at the free cash flow, right? They have like 1.6 billion of free cash flow, but they are reporting 3 times the net income. So that I don't really like that. So in my opinion, for Netflix to be like at the fair value, and I'm not gonna even do 15 multiple of free cash flow, I'm gonna do a 20. Netflix should be like a $30 billion company, and it's at 200. So it has to drop quite a lot, like 70%, something like that. And then I would be interested in Netflix. And same for Tesla, right? Tesla has a PE of almost 78. I mean, what's up with that? It's too high. They're reporting a net income of 12 billion, which is pretty good. But the cash flow is 7.5 billion, and that's not good. What is good though is that free cash flow is going up at a pretty fast rate. So again, I would not pay only 15 multiple of free cash flow. I would probably pay a 20 multiple for Tesla. And that would mean what? Tesla at 150 billion. 150 divided by 800 is what? It should fall like, again, 70-80%. Let's see. let's actually see. 150 divided by 833. Yeah, should go down like 80%. And then I would be interested. What does that mean per share? Well, if it goes down 80%, that means 20% is left from the share price. So 0.2 times 263. I'm interested in Tesla at around $50 per share. I would really buy. It got close-ish, because Tesla did drop to like $100 per share back in January. And I was I had it on my watch list. I was very keen for it to reach this like below $60 per share. And I would have bought. And yeah, at that point, I would have had like a good price on Tesla, you know. Like, again, you can trade Tesla. Tesla had a massive run, but I don't want to buy overpriced companies. I want to buy fairly priced companies, right? So the Nasdaq is still a bit it's still overvalued. I hope this is the trend that follows, and I'm gonna start to be interested in this $10,000 range in the Nasdaq 100, because even though it's almost the same price as here, there's like a 2 years gap, and GDP is going up. So $10,000 in 2024 is not the same as $10,000 in 2022. This is cheaper because GDP goes up with time, usually. We'll see how that works out. S&P also dropped, not as much. The Dow Jones, honestly, it doesn't really matter, because the Dow doesn't care about the value of the company, but the share price. So that's stupid. And I should really, I just have it here because I didn't know that before. Now I do. I'm just going to track it, but I don't think I will ever buy the Dow Jones, because it's not market share based, it's share price based. And that's stupid, in my opinion. Yeah, so there's this article for Barron's, why Tesla went down. If you want to go ahead and read it for yourself. But long story short, operating profit margins dipped a lot. And of course, that's pretty bad, because they need to sell a lot more volume in order to get some profit. So that's my update on the stock market. I hope you learned something, and I'll see you in the next video. Bye for now.